Oil prices hit a 6-month low, and the US dollar drops another 1% on fears trade wars will lower global growth. Private sector strength helps Australia's economy grow 0.6% in the December quarter. China sets a new annual growth target of around 5% per year amid tariff disruption and powered by government spending. And the Reserve Bank of New Zealand's governor resigns unexpectedly. That's coming up in our 5 Things in 5 Minutes on Thursday, March the 6th. And then in today's bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, looks at whether the GDP growth Australia experienced at the end of 2024 can be sustained through 2025.
The economy ended last year growing at almost at an annualised rate of 2.5%, which is not that far off where we think trend or potential growth in Australia might be.
But first, in 5 and 5 with ANZ, global market turmoil continued overnight, with oil prices falling more than $2 a barrel to 6-month lows, and the US dollar falling another 1% on fears trade wars will hit global growth and consumer and industrial demand. In a speech to Congress, President Donald Trump confirmed reciprocal tariffs would be applied from April the 2nd, and said Americans may experience some economic discomfort as trade wars take effect. ANZ economist Bansi Madhavani says from London this morning that markets are watching Trump closely.
Markets are very worried about downside risks to growth on the back of these tariffs. If you look at the pricing for Fed funds rate, markets are now pricing odds of over 75 basis points of rate cuts this year. And if you compare it to the pricing that was there just before President Trump was sworn in, at that time the pricing was 36 basis points. That's telling you that markets are quite concerned about this stagflation environment, and that's weighing on dollar assets as well, with the US dollar down 1% in the session today.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was flat, the US dollar index was down 1.2%, the US 10-year bond yield was up 4 basis points to 4.25%, and West Texas Intermediate crude futures were down 3.7% at $65.77 US a barrel. The Australian dollar, again because of that weak US dollar, was up 0.9% at 63.14 US cents, and the Kiwi was up 0.8% at 57.07 US cents. Number 2, Australia's economy grew 0.6% over the December quarter, bringing annual growth to 1.3% and per capita growth into positive territory for the first time in a year at 0.1% for the quarter. Here's ANZ senior economist Adelaide Timbrell on what drove the growth.
In Q3, the economy was mostly driven by an increase or a spike, really, in public demand. But in Q4, it was a more balanced outcome, with public demand adding 20 basis points to GDP growth in the quarter, net trade adding another 20 basis points, household consumption adding another 20 basis points, and then private demand adding 0.1 percentage points or 10 basis points.
Number 3, Adelaide says ANZ Research expects to see the private sector come in even stronger in coming quarters.
We've seen some nascent recovery or some leading signs of this in retail sales, in the household consumption data, and in consumer confidence. The 0.6% quarterly increase will be the first of many, we think, in the next few quarters. We're expecting to see a lot more stronger prints of that around 0.6. In fact, 2025, we see growth at 2.4% in the year, with mostly 0.6 quarter-on-quarter increases.
Number 4, China's government announced an annual GDP growth target of around 5% at its National People's Congress yesterday. It's the third year in a row that this goal has been set, although now comes amid a growing trade war with the United States. ANZ senior China strategist Xiaopeng Xing says that will mean fiscal spending will have to be stepped up.
U.S. tariffs will be the big headwinds into the second half of this year, but the impact, I think, at this moment looks marginal. We estimate the additional tariff will cut China GDP this year 0.5 percentage point, but the government has made very strong policy support to the economy. This year, the policymakers set the fiscal deficit rate at 4%, 1% higher than last year.
Number 5, the Reserve Bank of New Zealand's governor, Adrian Orr, resigned unexpectedly yesterday and with immediate effect, with 3 years left on his second term. Deputy Governor Christian Hawkesby will be acting governor until the end of March, before the government appoints a temporary governor for up to 6 months from the 1st of April, as it searches for a replacement. ANZ New Zealand Chief Economist Sharon Zollner says a key reason for the market not reacting much is that the official cash rate is set by a committee.
and most of that committee is still there, including the new acting governor, Christian Hawkesby. And the last monetary policy statement in February indicated that the decision to cut the OCR 50 points was a consensus decision. No vote was required. So I think the market's baseline is probably that the committee was on board with not only the decision, but with the published OCR track and with the stated strategy of slowing down rate cuts now as the official cash rate nears neutral.
Sharon Zollner there. Now, in our bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, talks to my colleague Alex Tarrant about what might underpin Australia's economic momentum into 2025 after that tick up in growth in the December quarter.
2024 ended quite well. If I look at growth in the final quarter of last year, we had growth of 0.6% for the quarter. Now, over the year as a whole, the economy only grew 1.3%. So almost half of that growth in the entire year came in that last quarter. So if you ask me about the performance of the Australian economy over 2024 as a whole, you'd say fairly sluggish on the GDP side. Employment growth was, of course, quite strong. But if you ask me about how did the economy end last year, I'd say the economy ended last year growing at almost at an annualized rate of 2.5%, which is not that far off where we think trend or potential growth in Australia might be.
Do you think it's possible for that to keep going, given that there might not be more rate cuts in the year or only one? But does that sort of strong labour market support the economic growth potential in Australia?
I think there are a few things that are going to support growth in Australia this year, and also some risks, of course. If I think about the things that are supporting growth, firstly, real household incomes are now growing. And so when I think about what people are earning, wages and salaries, you take out inflation, you take out mortgage payments, you take out taxes. Once you've done all that, you're actually getting growth in income. So after inflation, after tax, after mortgage payments. Now, that's really being driven and still helped by the stage 3 tax cuts that came into effect on 1 July last year. We, of course, don't see in the Q4 GDP data any of the benefit of the Reserve Bank's interest rate cut that we got in February. And it won't really be until we get the second quarter GDP data for Australia, which won't come out until September this year, that we start to see in the hard data some of the evidence or some of the benefit for households of that interest rate reduction. It looks like on the property market, there's been a little bit of a response potentially to that interest rate easing. But if I step back, I'd say I had the tax cuts sort of supporting growth from the middle of last year on. I've now got monetary policy supporting growth with that interest rate cut. I've also got, and this is really important, lower inflation. And that means that the wage rises that people are getting aren't being taken out immediately by higher inflation. And so I think that household income dynamic is changing and has changed. And I think we saw that then reflected in household consumption growth of 0.4 in the final quarter of last year. Now, you wouldn't call that strong, but certainly it's a step up from where household consumption growth was running over the majority of 2024.
Those households are now going to be looking across the year and wondering if there's another rate cut in the offering. We've had various communications from the RBA in recent days, the minutes from that rate cut meeting and also a speech. Where do you think the RBA sits in terms of what it might do over the next year and any implications from these GDP numbers?
I think the GDP numbers tell us that the economy ended last year in an okay shape, but I think it probably doesn't tell us a great deal about the forward trajectory. That is, yes, the economy ended last year with a bit of momentum. We think that momentum is maintained through the first half of this year. But if I'm thinking about monetary policy, then the things in the mix, if you will, is not just what's the momentum in GDP, but where's the labour market going? What's the outlook for inflation? And then what's the balance of risks around all of those? If there's been one clear message from the Reserve Bank's communication this week, I'd take it to still be that the Reserve Bank isn't expecting to cut rates as much as the market is expecting the Reserve Bank to cut rates. In our forecast, we've just got one more rate cut, and that's in August this year.
Adam Boyton there. And tomorrow, Adam will dig more into why it looks like the RBA will only cut rates once more this year. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 6th. Catch you tomorrow with a rates decision from the European Central Bank, which ANZ Research expects will be a 25 basis point cut to 2.5%. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.